In this lesson, you're going to learn about some of the advanced additions to our enterprise value calculation right here that I touched on briefly in the previous video, but did not have a chance to go into detail on. Now, to start with, I want to mention that with all of these additions that we're going to look at, your chances of getting interview questions on these topics is relatively low. Even if you've had previous finance experience, interviewers usually do not focus on these questions. So if you don't understand everything 100% here, don't worry about it too much. Just be familiar with the basic concepts. Now, the reason we have to go into some more detailed adjustments and some more detailed calculations here is because oftentimes with real companies, when we're calculating enterprise value, as we are right here, there are other variables that come into play and other factors that we need to consider. Other items, for example, may act sort of like cash and investments. And then on the flip side, on the reverse side right here, there are other items involved in a company's financials that may act like debt or other liabilities, other obligations that need to be repaid. So let's start on the cash and investment side. And really, I think the two main additions that we can sometimes make here are net operating losses and then investments in other companies. I'm just going to label this equity investments. So net operating losses, this refers to scenarios where a company has been unprofitable over a long period of time. So their pre-tax income has been negative, and as a result, they have paid no taxes or very little in taxes. And so over time, they've built up a tax credit. So they've built up this tax credit, and they have a balance of net operating losses. Now, the reason this is valuable and the reason we count this as a cash-like item in some cases is because of the value to the acquirer of the company. Because what happens here, and I'm not going to get into all the details, but what happens here is that basically if you have net operating losses like this and another company buys your company, then those net operating losses can be used to offset the acquirer's pre-tax income and can reduce their tax burden. So the acquirer always sees value in net operating losses. Now, exactly how you calculate the value and the formulas and everything like that goes beyond the scope of what we're going to cover in here. This is covered in detail in the advanced modeling series when we look at Yahoo's net operating losses. So if you want to get more in that, you can look at that part of this program. But that's the basic idea, that if you have net operating losses like this, they create a tax credit and they can save the acquirer, anyone who goes to buy your company, they can save that company money on taxes. And so that's why they're counted as a cash-like item here. Now, equity investments are, once again, investments in other companies, but in this case, we own less than 50% of the other company. Remember that minority interests refer to cases where we own over 50% and we're adding back the portion that we don't own. So if we own 75%, the minority interest here would represent the 25% that we don't own that we're adding back. Equity investments work differently, and equity investments refer to cases where we do not own the majority stake in a company. We own less than 50%. And the reason that these are counted as a cash-like item is because you could sell them to get cash, very simply. So let's say we own a 30% stake in another company. Well, if an acquirer comes along and buys us, they could potentially take that 30% stake that we own, sell it, and then turn it into cash, a liquid asset. Now, this gets complex because when we look at equity investments like this, it's not quite as simple as just taking the portion or the percentage that we own and just adding it to this formula. We need to adjust it and we need to apply some type of discount rate because it's not as easy as just going and selling that 30%. Again, I'm not going to get into the details and all the math here because it's not going to come up in investment banking or private equity interviews. It's more the type of thing that you need to know when you start working or when you're working with a company that has this type of thing. And once again, it's covered in the advanced modeling course where we go into Yahoo's equity investments and we take a look at how to value them and how to factor them into this equation. So those are some additions on the cash side. Now on the debt side in this scenario, so other debt-like items, we've already been over debt, minority interest, and preferred stock. And then we had this other category, other liabilities right here. So there are really three main items on the debt side that I want to go over right now. The first one is capital leases. The second one is pension obligations. And then the last one is other obligations. And this one could refer to restructuring, environmental, and so on and so forth. So to go through these in order, capital leases. So when a company rents office space, it takes out a lease on that office space. And if it's just renting it, then usually the expense, the rental expense for that office space is recorded as an operating expense on their income statement. Nothing shows up on the balance sheet because it's just a lease. They don't actually own the asset, and so it's going to hit operating income. With capital leases, by contrast, you have a different scenario, and what happens here is that the company actually has some type of ownership option, and in addition to that, the rental expense from capital leases does not show up under operating income. It doesn't hit operating income. What happens instead is that you count it as interest expense, and so it's going to affect pre-tax income. And then also, as a result of that, you're going to have usually some type of depreciation expense. And so you really count capital leases more like a combination of debt and then owning PP&E or owning other assets, because you have interest expense and then you have depreciation as well. So if you have something like this, and it's usually broken out and listed very clearly in a company's filings if this does exist, then this needs to be counted as a debt-like obligation as well and added to enterprise value. So interest expense, depreciation, ownership option. Now, pension obligations, this refers to scenarios where a company, for example, has agreed to pay out a certain fixed monthly amount or yearly amount to employees that are retiring. So owed to retiring employees. And the issue here is that oftentimes a company in its early years can set a policy for pension obligations that is very difficult to sustain in later years. And so what ends up happening many times is that they have this huge obligation, a huge liability on their balance sheet. And in many cases, it can actually cause a company to become very troubled or possibly approach bankruptcy, because there's just no way they can afford to pay back this type of obligation with their cash balance. And so they often run into a lot of financial trouble from these pension obligations. Now, similar to debt, this represents something that needs to be repaid at some point in the future to the employees in this case. So we count it as another debt-like item because it needs to be repaid to employees. Again, there is some math that goes into this. We're not going to cover it in detail here because, again, you're not going to get questions on this type of thing in interviews. This is something that would only come up if you have a lot more experience or if you're in a more advanced type of interview, or maybe if you've worked on a company that has a lot of these pension obligations or something along those lines. And then the last category here is other obligations. So restructuring, environmental obligations, perhaps litigation in some cases. This really is sort of a catch-all, and it's referring to cases where a company has done something incorrectly or done something wrong, and in the future it needs to make payments to some other party. So maybe it's the government for environmental obligations. Maybe they did not obey environmental laws, and so they now have some kind of future liability or future obligation they need to pay back to the government or another party. For restructuring, maybe as a result of changing around their company, they owe a spun off division of their company or some other party some type of restructuring fee in the future, or they're recording the fact that they're going to have to pay this fee to restructure their company, to lay off employees, and to change around the divisions of the company in the future. So there are a lot of things that could be classified under the scope of other obligations, but these, the ones that I just went over now, are some of the most common ones. So this is really just like a catch-all, and this is really just obligations owed to anyone. And once again, how seriously you take these additional items versus how seriously you take the ones, the kind of standard ones that we looked at here. This one is really up to your bank and your group. Some places place a lot of emphasis on items like this, and they actually want you to go in and value each thing here and to go into an excruciating level of detail on it. So it really depends on your bank and your group with how much detail you want to go into here. If you want all the math behind many of these items, look at the advanced modeling course where we go into it in more detail. In the context of interviews, again, it's good to be familiar with these, but honestly, you're not going to get extremely advanced technical questions on all the math behind all this. if you want to get a sense of what goes into capital leases, I'm just going to go over this briefly. The tricky part with capital leases here, and this is actually something that could potentially come up in an interview, so I want to cover it briefly here. The essence of this is that sometimes you have operating leases and they should really be counted as capital leases. Now, to actually do this, you have to have 4 conditions that are true. So any one of these 4 conditions must be true for an operating lease to be counted as a capital lease. First off, there must be a transfer of ownership at the end of the period. Second, there may be an option to purchase asset at a bargain price. Third, the term of the lease is greater than 75% of the useful life of the asset. And fourth, the present value of lease payments is greater than 90% of assets' fair market value. So any one of these 4 conditions has to be true for an operating lease to be converted as a capital lease and then added to enterprise value, as we have shown right here. Now, the first 2 options here, these are actually very difficult to assess based on the company's filings. If we go in and look at Apple's filing right now, I'm just going to search for leases. So you see right here, they have the operating leases amount. Just searching through this. We see here under lease commitments, they list out the leases right here, and they give a sense of how long the leases last for. So they have terms of 1 to 20 years, renewal options of 1 to 5 additional years. But the problem here is that although we have their lease expenses in future years, we don't really have any information on options 1 or 2 right here. And then for option 3, well, we don't really know what the useful life of any of these assets is because we do not have that broken out. They do not list this information in the filing. So really all we could do here is option number 4. Look at the present value of the lease payments and see whether or not that's greater than 90% of the asset's fair market value. So if we actually wanted to do this, we would do something like entering the lease payments right here, 222, 234, 228, 214, 199, and then we can just enter 825 right here for simplicity. And we would use the NPV function in Excel. We would pick a discount rate. We can just say 10% here. This would normally be linked to our discount rate in our DCF later on. And then we could actually go through and take a look at this. We see the NPV here is 1.3 billion. The problem here is that, again, what is the asset's fair market value? We really have no idea. We know that they have 1.9 billion in total minimum lease commitments here, but to actually get the fair market value of the assets that these lease commitments refer to, we'd have to talk to accountants, auditors, the CFO of the company. And so the math here you can do if you have the right information and you know all this. The truth is that in investment banking, people sometimes refer to whether or not operating leases should be counted as capital leases, but the truth is you hardly ever do this exercise because you just don't have the information. You hardly ever know whether options 1 or 2 here apply. You never know the useful life of assets like this, and it's very difficult to assess the fair market value of assets like this. So this is very much a theoretical exercise that I just went through with you here to show you how this works in theory. But keep in mind that in investment banking, you hardly ever actually do this because you simply don't have the information in most cases. You need to go to a lot of other parties to get it. And if you're just doing a quick valuation of a company, you're not going to have this type of information. Now, if you're working in a situation where leases are very important, such as for a retail company, for example, then there are other ways to get around this and to avoid the necessity of having to calculate all these numbers and figure out what a company's capital leases are really worth. So there are other ways to take a look at this and to figure out what's going on and to adjust for these leases. We're going to be getting into some of those in the next few videos when we go into valuation metrics and multiples, and I'm going to show you a real-world example of how we could use a multiple rather than looking at capital leases and making all these calculations and determining the asset's fair market value, and I'll show you how we can use that instead to figure out what effect the rental expense has and how to normalize a company's financials to take out the effect of paying rent. and how to do it much more efficiently than what we have here for converting operating leases into capital leases. So it's really more of a theoretical exercise, but I wanted to show you because I have gotten some requests on this and some requests to cover this material, at least briefly, in this course. So those are some advanced additions you could make to enterprise value. Again, if you want more on all these, look at the advanced modeling course. You're not going to get questions on these for the most part in interviews. It's good to be familiar with the basic concepts, but don't worry about understanding all the finer points. This is really more of a topic that you need to know once you actually start working in investment banking or private equity and you're dealing with these on a daily basis. Coming up in the next video, we're going to be getting into some of the key valuation metrics that you use. And we're going to be looking at them and seeing how they're linked to equity value and enterprise value. And then you'll get some practice actually making the calculations for these key metrics. And you'll see how they're used to create what are known as valuation multiples, which is what we're going to use to actually value Apple in this scenario.